What in the world is going on with England and why should you care? Well, we're going to find out. I'm Michael Smith. Welcome to the Lowdown. Let's start with England. Here recently, the UK cut taxes to help a struggling economies. We know everybody is struggling dealing with inflation. However, this was a wrong approach because it led to higher yields. And when yields go higher, what happens to bond prices? They go lower. So let's talk about the UK. UK has a large amount of pensions that use leverage, and the underlying bonds are the collateral. So if the price of the collateral falls, guess what happens to UK pensions? They get what's called margin calls. So this has been a pretty bad situation over in the UK as we've been seeing. However, the implications for the US could be a weaker dollar. This also could create some near-term market volatility as that situation worsens. Now let's talk about bonds.
Good evening, Mr. Bond.
Bonds have three pillars: income, stability, and liquidity. What we've seen over the last decade, the income component hasn't been so great. A year ago, on a 10-year treasury, probably 0.71. Now you could get about 3.75, so a significant change. This year has been probably what would be the worst year on record for bonds. So we've been talking about potentially a reversion to the mean. And if you remember, over the last 3 years, we've been suggesting here at Avidian a yield replacement, coming out of low yielding bonds, looking for alternatives to replace yield. That could be changing of looking back to getting in bonds and adding bonds back into your portfolio. The 10-year right now could be peaking around 4%. So this could be a great opportunity to replace some bonds and get some fixed income in your portfolio. Well, let's talk about the elephant in the room, inflation. We did see an increase in CPI, the Consumer Price Index. So it's up to 8.2%. However, the percentage of increase is actually slowing. We've seen a drop in gasoline, we've seen a drop in food. And if you look at one of the other components, it's called core CPI, which strips out food and energy. Now, core jumped to 6.6. Why? Owner's equivalent rent. This is 30% component of CPI. Rising housing costs has sent what? Rents higher. Ask anybody who's renting an apartment, rents are increasing. Bad news is good news. Mortgage rates going up has slowed the rise in home prices. While that may sound like bad news, it's good news. Why? The biggest component of CPI, that owner's equivalent rent, rents lag 10 months behind home prices. So if you start to think about inflation by the second quarter of next year, inflation could be in a fast decline. There's your good news. Another component, jobless claims have already on the decline. As we discussed last week, one of the catalysts for a new bull cycle could be jobless claims on the rise, which would do what? That leads to a Fed pause or pivot in terms of raising rates. So the question I get a lot is, should I get out of the market? Well, let's talk about that for a minute, and let me point you towards this chart. So looking at this chart, in the past 20 years alone, the S&P 500 has annualized 9.7%. However, missing just 10 days of the market's best days, which tend to occur within less than 1 month of the 10 worst days, would have reduced your annualized return to 5.5%. So what does that mean? You're not going to time this market. Stay invested according to your financial plan. As always, I'm here for you. Send me an email, give me a call. Thank you for listening to The Lowdown.